Hello and welcome to Financial Intelligence. This video, I want to introduce you to 6 highly rated mutual funds and ETFs that you should consider if you want to protect your investment portfolio against inflation. These mutual funds and ETFs will give your portfolio exposure to certain asset classes that have been historically resilient against inflation, and they are also endorsed by the top investment research firm Morningstar. If you are interested in these types of topics, don't forget to like this video and subscribe to this channel and hit the notification bell so that you don't miss any of my future videos. A disclaimer before we get started: note that I'm not a financial advisor and the content provided in this video is based on my research. For professional advice, you should talk to a financial advisor. In the first part of this video, I'm going to quickly talk about 4 asset classes that are in general considered good hedges against inflation. In the second part of this video, I'm going to explain how you can screen for highly rated mutual funds and ETFs. And finally, I'm going to share with you these mutual funds and ETFs that you can add to your portfolio as a hedge against inflation. Part 1: Protection against inflation. The ideal investments for hedging against inflation include those that maintain their value during inflation or that increase in value over that period of time. We know that inflation increases the cost of products and services. Any investment that stands to benefit from these price increases is considered as a good hedge against inflation. With any diversified portfolio, keeping inflation hedge asset classes on your watch list is critical. Gradually investing in these types of assets over time can help your portfolio thrive when inflation hits. Common anti-inflation assets include Treasury inflation protected securities, or TIPS for short, various real estate investments, commodities, and precious metals. If you are interested in learning more about these asset classes, you can watch my previous video on this topic. I'll post the link to that video up here. Part 2: Selection criteria. I've used 2 criteria to choose these 6 mutual funds and ETFs. The first criterion was to only choose mutual funds and ETFs that track one of the 4 anti-inflation asset classes that I mentioned earlier. The second criterion was to choose mutual funds and ETFs that have had a solid track record of risk-adjusted returns and lower management fees. I have identified these mutual funds and ETFs using the amazing tool offered by Morningstar, which is an independent investment research firm. You can actually create a free account on their website to access their data during their 14-day trial period. I will add the link in the description box below if you're interested to check it out. Morningstar has come up with a rating methodology for mutual funds and ETFs that is widely used in the industry. These ratings reflect Morningstar analysts' forward-looking analysis of a fund expressed on a 5-star scale, with 3 positive ratings of gold, silver, and bronze, a neutral rating, and a negative rating. The main takeaway from this part of the video is that the 6 mutual funds and ETFs that I am going to share with you track one of the 4 anti-inflation asset classes and are gold-rated funds, meaning that they are among Morningstar's top recommendations. Part 3: Selected mutual funds and ETFs. As I mentioned earlier, the 4 asset classes that provide good protection against inflation are TIPS, various real estate investments, commodities, and precious metals. While doing my research on Morningstar's website, I was not able to find any gold-rated mutual funds and ETFs that would provide exposure to commodities or precious metals. Therefore, mutual funds and ETFs that I'm going to share with you here are focused on either tips or real estate. The mutual funds and ETFs shown on this slide will provide exposure to tips. If you're not familiar with what tips are, you can watch my previous video on this topic. Again, I'm gonna post a link up here. These funds are all gold rated according to Morningstar's website. The first column in this table is the fund's Sharpe ratio, which is a measure of risk-adjusted return. It describes how much excess return you receive for the volatility of holding a riskier asset. The higher the Sharpe ratio, the higher the amount of returns you receive for taking on the risk associated with investing in that fund. The second column shows you how much money you would have had today if you had invested $10,000 in the fund 10 years ago. The third column is the management fee, which shows you how much money each investment firm is going to charge you for managing the fund. The two Vanguard funds have higher Sharpe ratio, which means that they have less volatility. However, these two funds have had lower gains over the past 10 years, as you can see in the second column. The management fee is very low for all of them compared to the industry average, which is roughly 0.4%. Note that there's no clear winner here because higher gains usually come with higher volatility. At the end of the day, it's up to you to decide which one is the right choice for your portfolio. The mutual funds and ETFs shown on this slide will provide exposure to real estate. They are all also gold rated according to Morningstar's website. These funds have lower Sharpe ratio because historically they have offered higher returns, but they are also more volatile. The second column again shows you the amount of money you would have had today if you had invested $10,000 in these funds 10 years ago. All of them have performed more or less the same and also have relatively small management fee compared to the industry average. Therefore, any of them is a good hedge to consider against inflation. I hope that you liked this video. If you have any suggestions or comments, please add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.